People that don't know anything about guns, they're going to just go buy it. It's no different with stocks. And I say that because stocks can be dangerous. Investments can be dangerous.
What are some of the, like, having years of experience, what are some of the classic pitfalls, even with today's technology, where you see the same type of pitfall over and over again that investors are running into or thinking is the right thing to do, but like you guys see the bigger picture and it's not? And I guess on the flip side of that, what are some of the no-brainer things that we should all be doing with our money to be thinking ahead?
I think some of the biggest mistakes, one is people think choosing investments is easy. And, just because you can go into a gun store and pick a gun and ammunition, you can buy it just like that. Well, assuming you can buy it. It doesn't mean you know how to operate it. You don't know what the dangers are. You don't know how to actually you don't know any of that stuff. So somebody that's really experienced with guns, they look at the buying process as just benign. Like, who cares? People that don't know anything about guns, they're going to just go buy it. It's no different with stocks. And I say that because stocks can be dangerous. Investments can be dangerous. So just because you can look up a price or you can see something promoted on the internet and you can look up what people's opinion is of it, does not mean that that's the right thing to do. And so the biggest mistake I see now is people have overconfidence with what the internet information is to make financial decisions. And so that's the biggest mistake. And I think the second huge mistake is people don't ever consider taxes. And so, if you are engaged in, I'll give you a great example. I just met with somebody that's got 15 million. He's decided that he's going to put 5 million with this advisor, 5 million with this advisor, 5 million with this advisor. I said, why'd you do that? Well, I want to diversify my advice. Okay. So when we looked at his, tax returns, his rate of return was pretty good. It was about 9%, not bad, but it's hard to go wrong with the markets the way they've been in the last 2 years, right? I'd say, a blind squirrel can even find a nut. Yeah. And it's kind of what it is now. So anyway, out of this $15 million, he's got somewhere around $1 million coming in taxable dividends, interest, capital gains.
Because nobody sees the full picture.
Well, because all these different advisors, they're all doing their own little thing. No one is looking at his tax returns. They're just trading away, creating capital gains, creating dividends. And so I said to him, you're worried about your performance and trying to nix these guys out. I said, had you just bought the S&P 500 and the long bond index, you'd have saved yourself close to $400,000 in taxes. And your performance would have been actually a little bit better. Yeah. So the mistake is not having a good plan. It's all thought out. And you think by diversifying advisors, that's going to be good. It comes down to not just understanding how to assemble a good tax plan.
It's the simplest things that are the easiest to overlook sometimes because you like the shiny objects. You got to look for the shiny stuff.
Yeah.
Hey, home service heroes. Thank you guys so much for tuning into our home service happy hour content today. I sure hope you learned a little something. And I sure as heck hope that it was entertaining. If you did find it fun and entertaining, make sure you like and subscribe to the channel for more cool, fun, entertaining business content. And speaking of which, stay tuned. There's a little more here and a little more right here. Check it out.